Should you buy now or wait for the bottom? Well, that's the wrong question, because nobody is ringing a bell at the bottom. And by the time the data confirms it, the moment has already passed, and every buyer who was waiting on the sidelines is back in the market at the same time as you. There is a much better question you should be asking, and at the end of this video, you will know exactly how to answer it. And this is the same framework we use for our clients at Handle Properties right now in this market. So let me show you why this question is so hard to answer right now. And it's because the data is genuinely split. So let's start with interest rates. The RBA held steady at its June meeting. And here's the actual statement. At its meeting, the board decided to leave the cash rate at unchanged at 4.35%. Held, not cut. And further down the same statement, the board leaves the door open to another rate hike. It will do what it considers necessary to achieve that outcome, including increasing the cash rate target further if required. So rates aren't falling yet, and they might not be done rising either. Now here's what that's doing to sentiment at the coalface. The combined weekend capital city auction clearance rate for the week ending 21st of June fell to 47.4%. This is the first time since the beginning of COVID in April 2020 that auction clearance rates were below 50%. And on the back of that, Westpac has just now downgraded its own forecast. Westpac is now forecasting a 3% drop in Sydney property prices this year, as well as 4% in Melbourne, which would cause the overall capital city price growth to be flat in 2026. With rates on hold and possibly rising again, clearance rates at a 6-year low, one of the big four banks forecasting outright falls, well, that's the case for waiting. Now, let me tell you why that's only half the picture. And here's what the wait for the bottom argument always leaves out. Sentiment and supply are two completely different things. Moving on to completely different timelines. Sentiment can turn in a single quarter, but supply takes years to fix. So let's look at the supply data. The latest ABS approvals data came out this month, and total dwellings approved fell 1.1% to 17,000, still falling and still nowhere near what the country needs. Here's the 5-year picture from the National Housing Supply and Affordability Council. The council estimates around 980,000 new homes could have been expected in the accord period against a target of 1.2 million. That's 220,000 homes missed over the last 5 years. And that gap does not care what the clearance rate did last weekend. That's a fundamental imbalance. Now here's a part that should tell you everything about how unreliable waiting for certainty actually is. The banks themselves can't agree on what's happening to prices right now, in the same city and at the same time. CBA predicts property prices to rise 2% over the next year. One major bank says Sydney will rise, while another says it's going to fall 3%. If the professionals who lend the money can't understand what's going on or can't agree, waiting for the data to be clear is waiting for something that isn't coming. There is no green light, and there never has been, nor will there be. So here's the actual framework you should think about. 4 checks. Not a prediction, but a process. Step 1 is stop trying to time the bottom. Timing the fundamentals instead. You're never going to correctly pick the exact week clearance rates trough, and nobody does, not even the banks, as we just saw. What you can assess is whether a suburb has the underlying fundamentals to outperform over the longer term, regardless of where the cycle is. And that's a supply-demand in question, not a sentiment question. Step 2. Stress test your serviceability at today's rates, not a hoped-for one. The RBA said it plainly. Another rate hike is still on the table, including increasing the cash rate further beyond that if required. So if your numbers only work out assuming a rate cut that hasn't happened yet, well, guess what? They simply do not work. Structure the purchase so it holds up at today's rates and higher. Anything better than that is just going to be a bonus. Step 3, use soft market as leverage, not a reason to freeze. A clearance rate this low means one thing for buyers with finance sorted: less competition, more negotiating room, and vendors who are realistic about price. The most recent 4-week average was 48.9%, down from 53.2% in the prior 4-week period in terms of auction clearance rates. This is exactly the environment where a well-prepared buyer gets a better outcome, and they will once sentiment turns and that avalanche of buyers comes back. Step 4, match your holding period to the actual rate cycle, not the headline cycle. If you're banking on a rate cut to make this work, know what you're actually banking on. ANZ predicts September and December of next year for the first rate cuts. CBA predicts it to start in May and August of next year. NAB predicts in June and September of next year. And Westpac currently predicts 2 more rate hikes in August and September, bringing the cash rate to 4.85. 3 of the 4 major banks don't see a cut until 2027 at the earliest. One still expects further rate hikes. So if your plan depends on relief arriving in the next few months, you are planning around a scenario the market itself doesn't expect and nor can agree on. Buy for a holding period long enough to ride out the actual cycle, not the one you're hoping for. 3 things to do this week, whichever side of the buy now or wait you currently sit on. Step 1, get pre-approved at today's rate, not at a rate you're hoping for. The one on the table right now, with a buffer for further rate hikes if the RBA itself hasn't ruled it out. And if you're not finance ready, the timing question is just academic. You can't act on an opportunity you're not approved to move on. 2, build your shortlist now while the competition is thin. A sub 50% clearance rate means fewer buyers per listing. That advantage disappears the moment sentiment returns. Use it or lose it. Step 3, run the hold to 2032. Test on anything you're seriously considering. Ignore what the price does in the next 12 months. Ask whether this suburb has the population growth and the supply constraint and the infrastructure pipeline to be genuinely better into the next 6 years. If the answer is yes, the entry point within a given year actually does not matter at all. At Handle Properties, we're a Sydney-based buyers agency. We buy about 20 properties a month across all of Australia for our clients. The price points we operate in is basically sub $800,000. And that is where most of the quality stock for investors are in any given market at any given time. We are at this size by design. The big agencies will help you buy at volume, but when you are a big agency and have to fill a pipeline, you stop being selective. You buy what is available rather than what is right. We simply do not do that. And if you are a solo operator or a very small agency, you simply cannot match the agent relationships and off-market access we have built over the years. That access is how we find deals before they are listed. 20 properties a month means we are not selective on every single one. If it doesn't meet our framework, well, we do not buy it. That is the standard for our clients, and this is what we deliver. So if you'd like to find out whether Handle Properties is the right fit for your next purchase, head over to our website at www.handle.properties and book a strategy call with us. The link is also in the description. And follow us at Handle Properties on Instagram and YouTube for more videos like this.